Carlos Agostino. Let's say you get into a multifamily deal and you get it over the line after months of hard work. The next thing you need to begin is implementing your overall repositioning plan so you can start driving some returns. Well, needless to say, the upfront due diligence is a huge part of the acquisition process that'll save you time and money while you're defining the overall vision for the deal. Well, today's guest understands this concept very, very well. He has paired his construction company with a real estate investment firm. This advantage has allowed him to tighten up the rehab budget on his acquisitions.
Some research and looking at ultra wealthy individuals and how they were able to build their wealth. And a lot of it led back to real estate investing. So, all arrows were kind of pointing that way. So I started digging more into how to get started with investing in real estate, and did some things that I probably didn't need to do. I got my real estate license, I got my mortgage broker license, I did some transactions on that end, but all with the goal of doing real estate investing. Finally got a coach that kind of, sped that up. And at that point I had already graduated, had my electrical engineering degree, and I was working at UPS in their engineering department, and started closing a couple transactions to the point where I felt it was consistent enough to where I quit my W-2 and started doing real estate full time. That was, I think, creeping up on 14 years now. And then maybe about 3.5 years ago, I looked back and looked at what I had built, and I wasn't happy. I had started a construction company to help scale our fix and flips on single family. Did some holds, but not too many. We had some smaller multifamily properties and some single family, but for the most part, everything I was doing was very transactional, and from one deal to the next, and I hadn't quite built that generational wealth that I first sought out to do. So I kind of stepped back and I took a look at everything, and I knew a couple syndicators in multifamily. Well, back then I didn't even realize that they had syndicated the deals or how they had purchased the properties, but I started digging in there and asking them some questions. And then once I realized that what they had done to purchase those properties was to pretty much partner with others. And at that point I realized that was a better path to where I wanted to get to. So I started putting most of my focus towards multifamily. I did do single family and multifamily for a bit, but then I realized the power of focus, and I decided to just completely stop doing single family, sell off whatever we had left, and 100% focus on multifamily. Same with my construction company. So, now we only focus on renovating multifamily and commercial properties, but no single family. And, right now we're under management. We've got 1,720 doors. We've got another 850 doors under contract. We were on track to maybe getting closer to 3,000 plus doors at the end of this year. We might still get there, but, COVID slowed us down a little bit, but not too much. And, that's how I got where I am now.
Well, I'll tell you, man, if I would have known when I was doing my electrical engineering degree about all this stuff, my life would have been completely different. I'll tell you that. Because when I was, it's funny because when I did my electrical engineering too. And nice. But it's like, I back in Detroit where I went to school, I never saw myself as one of those engineers sitting behind a computer designing chips or whatever it is that engineers do nowadays.
Right.
Never
same here, man.
But I would say that real estate is far more rewarding, I would imagine, and both from the generational wealth perspective, and also I think when you're providing housing and you're helping other people, I think that has some good rewards in itself too. I would think, right?
For sure. I mean, I love to better communities, build transforming properties, taking what they look like when we buy them, and then once we fix them up, it's just, I love it.
Yeah So the advantage that you had though when you first started in this business is that you already had some single family under your belt, so you knew you were already familiar with landlord tenant law, for instance. You're familiar with lease ups, and you're familiar with all that fun stuff, and you're of course familiar with the operational side, which is absolutely huge in this business, right? But I think, but a key aspect is on the construction side, right? Where you actually built out a team before you even got into the syndication deal, right? So it sounds to me like you're at a clear advantage, because for many syndicators out there, they have to lean on their property managers or lean on on other external people when they're going in to assess a deal, where you don't really have that challenge because you're using all internal resources, right?
Yes, it's all internal. It's the team that I've put together, the systems I've put together. So I trust no matter what our CapEx scope of work is, that it's going to get done. It's going to get done right. We're not going to go over budget. And I think it definitely helps on the front end. When placing offers on deals, we feel a lot more comfortable on what it's going to cost, so we can get possibly a little more aggressive on our offers, and I think that helps a ton.
No, that's huge. I think that many syndicators that don't have the in-house resources will often pad the repairs or pad their reserves because they don't really know what they don't know, right? And
correct.
Where you have 15 years of experience of turning around units, and right, I'm sure you've seen some pretty rough things.
Yeah.
Especially in the single family space, you see a lot of crazy stuff. So it's like you when you walk into a property in a certain location, you kind of know what to expect already. You know the general idea of what damage you're going to have to repair and be aware of, I'm guessing, right?
Yeah, I mean, from our first property tour, I've got a pretty good idea when I leave that tour of what it's gonna cost, the CapEx. I'm usually maybe 5% plus or minus from the rough estimate I come up with then after I revisit it after our due diligence. I mean, it's pretty close.
Yeah. Now, but the key thing is that you're only buying your local area, which is, I know we spoke in the green room. You're based out of Dallas, and is that where the only place you're buying right now? Then, because of this key advantage that you have, or are you buying anywhere else?
No, well, anywhere in Texas, anywhere in Oklahoma. Last couple years, taking the same systems we had and making it easy to plug and play in other areas. We're to the point where we even feel comfortable, taking it further than that. Right now with Texas and Oklahoma, it's an easy drive if we've got to drive somewhere. But yeah, we're even open to going further.
Yeah. Good. Well, let's dive in a little more about due diligence. That's I tell people all the time, getting a deal is easy. Buying it is easy compared to operating it for 10 plus years. That's hard, but it all really starts right at the beginning. And what you encounter when you first walk that property is going to have an impact on what you offer, and then post acquisition too, what you're going to deal with after the fact. So as far as your due diligence is concerned, what are the things that you're looking for when you first walk a property, like you first step foot on a property? Are there key things that you just visualize you're looking for or not looking for when you first step foot on a brand new deal that you've never seen before?
Yeah, I mean, there's things you definitely want to focus on, things that can make or break a deal, things that can make operating the property a nightmare, kind of like what you said. The roof is one. You definitely want to have a good roof over your property. You don't want leaks every time it rains, that your residents are upset and there's water pouring in. So you definitely want a professional to check your roof, see what it needs to, whatever your business plan is. If you plan on holding it for 10 plus years, well, obviously you want a really good roof. If you plan on only holding it for 3 years, you want it to be good enough, I guess. Your foundation, especially if you're in Texas or Oklahoma, foundation shifts quite a bit. In some other areas, not really, but over here it does. So you definitely want to make sure your foundation's in good shape, and that usually leads into the drainage or the sewer lines.
Yeah.
When your foundation's shifting, it's usually one of those two. So if your water is draining towards your foundation and getting in that way, you don't have the proper downspouts or grading, and it's just going right back into the foundation. Those are things that I'm always looking at. And then the sewer lines, I always have those scoped by plumber during our due diligence. get a good idea of what we're looking at, see if we've got cracks in the lines, roots, or whatnot. Let me think what
Now,
else can be
George,
major there.
George,
Yeah.
before you continue, how big a deal is this that you're looking at before you're putting all this effort into it? Like scoping lines, all that stuff costs money as far as due diligence is concerned. What sort of scale are we talking about when you're looking at these deals?
So how much am I spending up front, or what am I doing before the due diligence?
More like, what are the size, like how many units is it? How much is it that you're talking about putting into your due diligence? That kind of thing.
Yeah, I mean, we like to do 100 plus units, and usually the bigger the better, 200 plus, even better. And then depending on how many buildings, they're usually going to charge you per building as far as scoping the lines. I mean, you could be looking at, somewhere from 5 to 10 grand possibly.
Yeah.
But it's
totally worth it.
Yeah, totally worth it. I mean, these are things you want to discover before your due diligence is over, in case you discover some really bad sewer lines, and you got to go back to the seller and get compensated for that.
Yeah.
Other than, I mean, the roofing, depending on how detailed you want. We do that in-house, so we get pretty detailed, but I mean, I would suggest getting as detailed as you can. You may have to pay a little bit for that to get, somebody that really knows what they're doing to look at the roof. Other than that, I mean, I'm trying to think of what else. Pests, you want to, if you have termites, you want to make sure you don't have termites, active ones at least.
Is that a big problem down in your neck of the woods?
It could be, yeah. We've ran into some issues.
Yeah. Yeah, because I know in some regions, in some states, getting someone even out there. Well, your inspector should be able to identify that. Like my inspector can tell me about termites, even though we don't have too many here in Ohio. But down in Florida, for instance, very sandy places, termites is definitely a problem, and bed bugs too. Bed bugs as well.
Yep. So that one's a little hit or miss. Sometimes you can not have to pay for that. Sometimes the pest company wants something. It's usually pretty minimal. Yeah, I mean, I would say plumbing's probably the highest price tag when it comes to due diligence. You definitely want to check every unit, and I say that because you want to discover every single down unit for sure. Like the down units are the ones that are going to cost you the most. They're going to be from 10 grand to 20 grand. Let's say you plan on doing a $5,000 upgrade to each unit, and you didn't check them all, and it turns out that there's 20 down units that the seller's trying to hide. Well, those 20 can be, worst case, 20 grand. That's a big difference. That's talking about hundreds of thousands of dollars difference if you've just budgeted for the simple 5 grand.
That's right. And on smaller deals, it's very hard to absorb a mistake like that. On bigger deals, it's a little easier, but on smaller deals, you make a mistake like that. That's huge.
I agree. The smaller the units, you don't have a lot of room to make mistakes.
Yeah. That's right. So when you're doing that, when you're going into and looking at every single unit, are you planning on, like, what sort of upgrade and finishes are you planning on doing? Like, what sort of are you matching it up to the neighborhood, or how do you define that? Like, how do you define whether you're going to keep it all the same or do a heavy lift on the deal?
It all depends on your return on investment. If you're looking at the comps and you feel strongly that if you put in 10 grand into the unit, you can get, $200 rent bumps, then it may be worth it. But if, the most you can get is a $50 rent bump, then you probably shouldn't be putting that much into the unit. It doesn't make sense on your return on investment. So we always take that into account. We take into account what the residents in that area for that property class are going to be looking for. What do they expect? And kind of, once we've got all that put together, we want to maybe do little things that make us stand out from the rest. Simple things like maybe putting in some plugs with USB if we think it's something the residents are going to appreciate and it'll make us stand out from the rest. Or a Nest thermostat, something like that.
That stuff is cheap too, right? I mean, it's not expensive to do that.
Right. One thing we if we're replacing countertops, the difference between Formica and putting a stone countertop isn't that much of a difference. So that's something simple you can do, and stand out from your competition.
That's well, you actually just brought something else up too. When you're doing your due diligence, how far away is the competition you're looking at? Like, are you looking at 3 miles away, 2 miles away, up the road? Like, what are you considering when you are matching up that deal that you're looking at and the fit and finish versus other ones that are nearby? Is that how big a decision is that in your overall driver and especially on the financial side?
No, I mean, we definitely don't want to be the first in the area to, we want it to be proven, whatever it is we're going to go in there and do. So comps are extremely important. As far as how far out we go, it just depends on the area. You know, we like to start with 1 mile. If there's enough properties within that 1 mile, great. But if we need to go out a little further, 2 miles, 3 miles, then we will. But I mean, definitely the closer, the better. And I know, at least in Texas, you know, you can be in one neighborhood and, you know, make a right and it completely changes, you know. And I know it's like that in several places. So
yeah,
as close as possible.
Yeah, that's right. Yeah. And that's the thing though too. It's like doing that due diligence as far as your comps are concerned is absolutely huge. I mean,
and I would say do your own comps. Don't just go by the broker.
For sure.
They're gonna pick the best ones, hands down, and you've got to do your own due diligence on that.
Yeah. So what sites are you looking at when you're doing that due diligence on the comp side of things?
Yeah, we use CoStar for the most part. You know, we'll peek at apartments.com, but yeah, we lean on CoStar quite a bit.
Good. So CoStar is actually pulling in all the rent comps. I imagine it's pulling them in from all the public sources, right? Like apartments.com or Zillow or wherever, right?
Correct. And there's little tweaks within CoStar. So if you don't, recently they made either they bought apartments.com or something, but the comps are all pulled from apartments.com if you don't mess with the criteria, but you can go in and you can mess with it. I don't necessarily like when it pulls it from apartments.com. So yeah, just little tweaks.
Nice. Okay, so good. So that's all good information there. So the next phase, or maybe one of your other phases, is evaluating the actual area and the demographics there. So when you're looking at an area, what sort of things are you looking for in terms of maybe income, jobs, that kind of thing? And what sort of tools are you using for that?
First thing is population growth. And usually we just, in Google, you know, you just type in the city and population growth, and right off the bat, it's going to give you a chart and show you the latest data that they have on population. So I start there. Then we want to look at if there is population growth, then okay, well, what's driving that population growth? What are what sectors are driving that? Is it all relying on just one? You know, are there different, is there medical, oil, is it spread out? Then take that same into the property. We want to see what the demographic of the residents are and where are they coming from as far as employers. And so population, what's driving the economy, and then kind of just really zeroing in on that location. What kind of class is that location? Is this somewhere that you're going to feel safe if you get out of the vehicle and go look at some units, or is this somewhere you're going to be ducking all the time?
Have to carry a gun. Have to carry a gun to walk through the neighborhood. Yeah.
So ideally, and I think this goes for everyone, but if you can find a C-class property in a B-class area, that's ideal, because the money you're going to put into it to bring it to that B-class, you should be able to get a good return on your investment.
Yeah, that's the unicorn everybody's looking for, though, right?
Right. Easier said than done.
Right. It's right. And I imagine, though, to find those unicorns, you're working directly with brokers, right? You're not going to LoopNet.
LoopNet? No. We yeah, mostly working with brokers. I mean, we've also gone straight to sellers at the same time. getting data from CoStar, and calling them and mailing them. But after we closed a couple deals, the brokers started coming more to us. That made it a little bit easier.
Yeah.
But yeah, not LoopNet.
Yeah. So, but it's interesting. You mentioned CoStar. So what you're doing is you are you have access to CoStar, the subscription, right? So for anybody out there, I mean, CoStar is what many of these commercial guys use to look for deals and get comps on them too. But you're using it in a way that just to find out who owns the asset and find a way to reach out to them. And sometimes they hide behind trusts and other LLCs. It makes it a little difficult to find, right?
Yeah. I mean, it's definitely not easy. And some of the data we get just leads us to a dead end. But we definitely give it a shot. I think we took that from single family. We used to do that with single family, and we realized not a lot of investors in multifamily do that. There is some softwares out there that are better just for that. I can't remember the name right now. I think it's possibly Reonomy is one of them.
Oh yeah, Reonomy. Yeah, sure. Yeah, Reonomy.
But
yeah.
With the subscription, the CoStar subscription is not cheap, so we kind of just stick with that. Same with rent comps. There's other softwares that are better with rent comps, but we found that CoStar at least has everything we need. It may not be the best in every sector, but it's we use it to the fullest.
No, CoStar is handy if you can swing it. Definitely. I mean, alternatively, if you have a good relationship with your broker might be able to find some of that information out there too. So for those of you guys listening, if you don't have access to CoStar, so build a strong relationship with your broker, and and you can sometimes ask them, hey, can you find me some deals? So now when you're going through and did you say for your demographics and all that, are you using CoStar for that too, or are you using other sources as well, or multiple sources?
CoStar, City Data.
Yeah. That's city-data.com. Yeah.
Yeah, and some other websites, pretty much anything we can find on Google.
Yeah.
We're not using any other paid software.
Yeah. I mean, but City Data is probably one of the ones that is most, I mean, I'm not going to say it's most up to date, but it's most used anyway by many syndicators out there.
Yeah. I mean, there's a ton of information you can find on there. It's not going to be, you're going to be about 2 years behind or so.
Yeah.
But it could still help you out.
That's right. And well, I think part of the what you're doing is you're focusing on one area. So what it costs to turn a unit, what your labor cost is, what the cost of management should be, for instance, all these different things. That gives you a clear advantage over some of these guys that are bouncing around from state to state that have no infrastructure built there, right? I mean, do you find that's a clear advantage? You touched on this earlier because it allows you to be more aggressive, right? More aggressive on your pricing.
Yeah. I mean, if you know the area, we go for the deals too. If it's outside an area that we know that we don't, if it's outside of an area that we know, we'll still look at it, but we'll dig really deep into that area and get familiar with it. And then once we've pinpoint, okay, we like this city, we've looked at all the data, it looks good, then we'll put more focus towards that city, kind of, going with what you're saying and focusing just in that one area because we know that meets our criteria. Let's find a deal. Yeah.
And then I'm assuming you're going down to the zip code level too. I mean, you're going pretty deep when you're looking at these deals, right?
Yeah. I mean, there's certain areas within an area that we want to be in.
That's right. I mean, yes, zip codes, even down to the same zip code, there may be certain blocks that you just want to stay away from. It's crazy how that works, right? I mean, you have one giant zip code, half of it might be terrible, the other half is okay. Mm-hmm.
One thing we do on the front end is when we don't know the city or the area very well, we also call the police station, and they're pretty helpful, letting us know what we're dealing with and whether we should be in there or not.
Yeah, that's right. Well, I also heard that they hold the drug sniffing dog trick, and you're familiar with that, I'm sure, right? Or if you take on a new property and you have to clear it out, you can ask the police to bring in the drug sniffing dogs.
Okay. Yes, I have heard that before.
Yeah.
I haven't done it, but I have heard that before. Yes.
Well, but I've also heard now, this is recently, that in some places they won't do it because you need probable cause.
Uh,
So I don't know. I don't know. Just putting it out
yeah.
there.
Well, I would. I don't know. I would think if we needed to do that, we may pass on that deal, but I don't know. Maybe
Maybe,
if it's
yeah.
the right price, and yeah,
Yeah, how much trouble do you want to deal with, right? That's what it
right.
comes down to. That's what it comes down to. So in terms of your processes and things like that, are you following like a checklist or something when you're going through and doing your underwriting, or how does all that come together? Like, is it all, you have it all process driven, or what?
Yeah, no, I'm all about checklists and making sure you don't miss something every step of the way. Uh, we don't have it down on every step as I would like to, but we're getting there. Every time we realize we're missing something or we should have it, then we add it to one of our goals to get it done, and yeah.
Yeah. Yeah, that's right. I mean, it's very easy to miss if you don't have an actual checklist of what you should be looking for, and on especially in large properties, and the bigger the property, the more complex it is, the more things you have to look out for, right? I mean,
Yeah.
you mentioned a 200 unit deal. Is that like a high rise or something?
No, just standard garden style.
Yeah. So in that case, you probably have like little balconies or something like that, I would imagine, right for the second floor. So if that's the case, then you have to take a closer look at some balconies, for instance. Maybe it's that,
Yeah.
maybe you need to look for how strong they are. Has the city made any complaints against the property and they're getting ready to condemn it, but the seller didn't tell you, things like that. All kinds of little things to watch out for when you're doing your due diligence that sometimes you just don't find. I mean, it requires a high degree of effort to really find it. Yeah. What are some of the other tips and tricks that you've used that you find that most people just are not aware of when they're doing due diligence?
You cut out there for a second, but I think I got you. So other tips during due diligence that investors may overlook. Let me try to think here on something that we've caught in the past. We didn't really go into, I guess, the other side of things. Obviously you want to make sure you're checking the leases and the criteria that they're currently using to take their residents in. We've ran into, and I think a lot of sellers do this, where they've kind of just put bodies in to show that the vacancy is lower. As soon as you close, those bodies are not going to pay their rent. So, you want to pay close attention to how much concession has been used to get the past few months worth of residents, and take that into account that you might lose a good portion there when you take over.
You got to watch out for heads on beds, right? That's what they call them, heads on beds. Yeah.
Yes. We run into that a lot.
Yeah.
On the construction side of things, you mentioned the balconies. That's a good one. We do see that a lot where, and sometimes it looks worse than it really is. There was one property where it actually had carports underneath, like the first floor was all carports, and literally looked like the building was caving in. Well, it kind of was, but there wasn't enough support under the carports. But
wow.
It looked a lot worse than it really was. All that needed to be done was it needed to be jacked up in the middle, and then you needed to put in some metal beams, and you were good to go. But looking at that, I mean, it looked scary. But
you have the know-how. That's the thing. I mean, you and your team have the know-how to look at a deal like that and say, that's easy. I mean, for someone, even an experienced guy might look at that and say, that looks like a big problem. Like a huge problem, right? But for you, it might be no sweat because you guys do this kind of stuff all the time.
Yeah, no, I mean, that was the first thing when I saw it. I would still like to get an engineer to look at it and confirm what I'm thinking. Yeah, and I realize that not every investor is going to have the construction experience. I always say just make sure you have somebody on your team, or you're going to hire a professional that does have that experience and that can help you through the process.
Yeah, that's right. And well, we started digging into the financial and the management side, the operational side of things. And you did mention leases. Performing the lease audit, absolutely huge, right? Looking at how long these people showed up, the tenants showed up. If they were all leased up within the last 30 days and now they're selling it, chances are those people are not sticking around, or they're going to sit there and you have to evict all of them by the time you take it over, and now you're going to be stuck with a huge attorney bill to get rid of all those people that just don't want to pay anymore. So yeah, that's something you have to watch out for. But it's kind of like it's a balancing act too, right? Because if you don't have the right occupancy, you're never going to get financing for it either.
Yeah, no, good point. I mean, that is a tough one, but
yeah. What sort of things are you looking for then when you're doing those lease audits? Is there anything like any special trick that you've encountered when you're looking at lease audits, or leases rather, like as part of your audit?
Just some of the stuff I mentioned, looking at the concessions, how much concessions are they giving? Is it extreme compared to your comparables, and the criteria they're using to approve the residents, and the documentation of that? Do they have it actually documented, or are they just saying that's what they're using? I mean, I think those two things are probably the most important.
No, it's huge. It's huge. And I mean, there's something else too that I found as well. Through a friend of mine bought a deal from someone, and it seemed as though about 40% of the property, the tenants, is a small property, like a 30 unit or something like that, and 40% of the tenants all worked for this owner. And
okay,
so you see where this is going, right? So when my buddy took over this property on closing day, they hand the keys, all those people bounced. All of them bounced immediately. Terrible for them.
Yeah, but that goes back to checking the employers.
Yeah.
And if 40% of the residents are with the same employer, that throws up a red flag for us. Because if something happens, this was a little extreme case where it was the owner, but right? Kind of goes with anything, if they're all working at Costco or I don't know, and that company goes bankrupt, then
you're hosed. Yeah, I mean, in this case, this guy had a restaurant, so he had all those people working at his restaurant supposedly. So it's like it's such a convenient setup here with that.
Right.
Ridiculous. Right. Yeah, but he got caught with that, but it's really, really too bad. But anyway, regardless, he was able to come out of it. He got it leased up, got it turned around, and it was cash flowing. Everything was fine, but very, very expensive lesson for those of you guys out there listening. Don't make that mistake. Don't make that mistake. And when it comes to editing financials and auditing financials, what sort of things are you looking for on the financial side? I mean, do you typically go so far as to ask for the tax returns and all that fun stuff as well? Are you looking for that kind of thing? Okay, so now when you're looking at these deals, then from the financial perspective, are you asking for tax returns, receipts, whatever else might be there to support the asset in terms of the financial side, to make sure that they're actually telling the truth when it comes to the financials and the numbers?
Yeah, I mean, we definitely try to. A lot of the deals we purchase are heavy value adds though, and some of the issues that we're trying to fix are usually bad property management, bad financials. So the reports are not going to look that great to begin with, and we know that. A lot of the stuff that we're projecting are things that we're going to have to put into play, and we know are not already happening on site. So, for the most part, the worse the financials look as far as how they're presented to us, the more excited we get, at least on the front end. So, that shows us that there's definitely room for improvement. We do want to verify as much as we can, obviously. And we've walked away from at least one deal because the seller just wouldn't supply us with anything. Like, He was saying you're buying it as is, and he didn't want to give us. He gave us the worst looking financials we ever seen, and then we wanted bank statements and just a little bit more, and he wasn't willing to work with us, so we walked away from it. And I think that was over a year ago, and he's still trying to sell it. So,
Huh. How big a deal is it?
it was a 200 plus. I think it was like 260 or so. Um, Actually, I think a group finally did close on it. I think it was like last month.
Yeah.
Yeah.
Why do you suppose someone doesn't want to hand over that stuff? Is it because they're maybe unsophisticated, or they think it's too invasive? Like, why wouldn't they want to hand over stuff like that? Was it, well, first off, was it self-managed? I imagine it was, if he's very skittish about that. Yeah, that's
Yes,
probably
so
one of the reasons.
self-managed. There was no third-party property manager, um, and this individual, I think it was more him than anything. Very, very arrogant, and just felt like he didn't need to supply any of that. But I could see where it could also be some of the things you were saying, where they feel like they don't need to give that information, and it's too, I guess, too much to hand over, which I mean makes no sense. To me, when I'm selling a property, I mean I want to be as transparent as possible.
You would think, right? Yeah.
Yeah, but I mean we run into it all the time where sellers are trying to hide things, and obviously they're trying to get as much as they possibly can when they're selling the property, and I guess they're banking on the buyer not being as educated or as thorough, and not catching some of this stuff. But we've caught sellers on quite a bit of things. I spoke about down units before. I mean, we've caught sellers that are literally trying to hide the down units from us, and we have to insist that we want to see every single unit till we finally discover that there's 5 units that were completely underwater, and that's why he didn't want to show it to us.
Like, when you say underwater, I mean it's covered in water?
Yeah, like there was a flood. Yeah,
That's what I thought. I want to make
literally
sure.
underwater.
Yeah, I mean, that's the thing. I mean, yeah, they'll hide anything, and in the commercial world, there's not too much in the way of recourse like there is in the residential side. That's the thing. You have to be diligent about that. You have to be.
No, for sure. I mean, you got your chance. That's your due diligence. I mean, that's the time to go all in and do the work. Some people get lazy. It's not easy. You gotta.
Well, I think part of it is it's not as sexy as acquiring an asset. That's
Right.
sexy,
Right.
but doing the hard work of due diligence, it really is a pain. It really is. But knowing how to do it, getting the understanding as to how to go through your checklist, do the research on the area, do the research on the asset, how's property management. I mean, you could even uncover some more value out of that thing.
For sure, we usually do.
Yeah.
We usually do.
Yeah. I mean, that happens to me all the time too. Yeah.
Yeah, I know the deal that we have under contract right now. We during due diligence, we realized that it's got a massive gym, and they're just not using it to its full potential. We could actually be selling memberships to outside organizations and charging them to use the gym. And that was all kind of discovered during due diligence. And you said it's not sexy, but we kind of use it as I was talking about this with another operator, but almost like a team building exercise, because our team comes together and we spend, when we did our 1,300 units, I mean, we spent over a week together every day working 10, 12 hours a day. And it created some cool moments, and kind of built the team together.
Yeah. And I think the thing is that when you have a team that's focused on one common goal, and it's 1,200 you bought all at one shot too.
Yeah.
You really need a team for that.
Yeah.
That's a lot of work. But really, you're making that investment only after you decide you put it in your strong LOI, and then you start all this work. So it isn't like you're just touring the property and doing all this effort before you actually have it.
At that point we're all in. You know, we try not to put hard money until the due diligence is over. Actually, we've never placed hard money before. I know some other investors do, and I know in some markets you almost have to. But yeah, so I mean, we're still all in, even though the money's not hard yet. And yeah, we put the work in, and we try to make sure we don't miss anything.
Yeah. Excellent. So it sounds to me like that overall advantage that you have when you're building out your team, or with your team rather, and looking at these assets is just magnificent, because now you can walk into a deal, you know what you're dealing with. It gives you such a huge advantage in terms of turning units and understanding the level of repair you have to do. So do you think it's a natural progression for most operators to start opening up their own property management and or construction groups, or would you recommend they don't do that? I'm not saying in your market, of course, outside your market. In your market, no one should do what you're doing. But in other markets, I mean, like, do you ever? What are your general thoughts around that?
Yeah, no, I mean, I think I've got a lot of thoughts about that. So I think it starts with your goals. You know, depending on what that individual or group's goal is. If their goal is to scale and, you know, get past 10,000 plus units under management and whatnot, then they have a decision to make. It's either bring it in-house and have more control, which is what everybody tries to do when they bring things in-house. But they do have to realize that at that point, you're not just building one company. Every one of those sectors is a different company within itself. The property management is a company within itself. The construction, same thing. Depending on what else you want to bring in-house. So you have to take that into account, and whether you have the bandwidth to do that, or if you have the team to do that. So I would say, you know, start with one, focus on one thing, and then maybe you just create a good relationship with a contractor, and you know, maybe bring them in as the general partner on your deals. And you know, we've kind of done that with the property management. So I'm not looking forward to bringing in property management in-house. I'm not saying I won't do it eventually, but just not looking forward to that business.
You got to find another person, another entrepreneur that wants to be part of, that wants to play the game every day, right? That's the key, right? It's just like you said, the last thing you want to do is take on a whole new business on top of the one you're already running today. That's a lot of work. That's a lot of work. Yeah, definitely. Okay, well, I think you've already answered this. I'm going to ask you anyway. Right. If you were to give your 20-year-old self a word of advice, what would you tell them?
20-year-old. I don't know if I answered this already, but maybe. But I mean, I would.
Indirectly, you did.
I would, and I always say this, but I mean, I would skip the single family and go straight to multifamily.
Oh, okay. Well, the way I saw it, you answered it when you said go into real estate.
Okay. I had already started looking into maybe at 20, but yeah.
Excellent.